This is Steve Wolf, and we're here with another Steve Stock Stories. Today, we are going to talk about leverage. Now, leverage is something that can really get you in trouble. As a matter of fact, here's a good story. Well, I don't know if it's a good story. It's kind of a sad story. Back in 1987, I was 1 year in the business at that time. And for those of you who are around and are adults, you would remember that 1987 was the year of the stock market crash. Doesn't sound so bad. The stock market was only down about 500 points in one day. The problem was that represented about 22% in one day, 22%, and eventually went down to around 30% before it recovered, and recovered fairly quickly. But let's talk about leverage. So why do I bring that story up, or that issue up? What happened back then when the market crashed was those people who were on leverage, and basically leverage means you're borrowing money to buy more stock than your cash. It's kind of, let me explain it a little bit in real estate terms, because a lot of people understand that. Okay, when you go buy a house, generally speaking, you're not paying full amount. You're not paying cash for 100% of it. Maybe you're taking 10% or 20% down. So let's say you buy $1 million house here in California, which is, it's probably a little shack with, one bedroom and about 300 square feet. But let's say that you're buying $1 million house and you put $200,000 down. That's 20%. So let's say a year from now, and we're just making up these numbers, it goes to, the house is worth now $2 million. So you decide, well, I'm going to sell that. And you get $2 million, and let's not talk about commissions or anything else, but let's say you put $2 million in your pocket. You actually took $200,000 out of your pocket for $1 million home. So you actually made another $1 million on that $200,000. So that means that you leveraged your money. You made about 5 times more percentage-wise than you could have made if you would have paid cash for the house. Same thing holds true with stocks. With stocks, you can buy on what's called margin, and it leverages what you have. So let's say you got $1 million, and you want to buy a lot more stock than $1 million will actually get you. So what you do is you borrow money from, it could be from Schwab, it could be from whoever the broker is, it could be Morgan Stanley, it could be Merrill Lynch, whoever you're with. Okay, they're going to say, we'll lend you a certain amount of money. So again, say $1 million, you can borrow about $500,000, and these are general terms, by the way, so don't say exact, but you could borrow about $500,000 on $1 million. It's about 50%. And as the stock moves up and down, first of all, you're paying interest on that loan, because that's what it is. It's a margin loan. And if the stock market goes down a lot, the percentage that you actually have versus the cash in the account starts going the wrong way. When you get to about a 70 or 75% margin, then the bank can come back, or the Schwabs or the Merrill Lynch's or whoever it might be, they can come back to you, and they will come back to you, and they say, okay, either you're going to have to sell some stock to get that margin back again to a better position for them, or so you're going to have to bring in money, or you're going to have to sell stock. So I don't remember what I just said first, but you're either going to have to bring in more money, or you're going to have to sell some of your stock. Well, who wants to sell their stock when it's down at the bottom? So this brings me back to what happened in 1987. So 1987 happens, and I remember it very well because I was only in the business maybe about a year and a quarter. And fortunately, I didn't have a whole lot of clients at that time, so I didn't have a whole lot of clients who could lose money. But the stock market crashed, and it was big. It was big. I remember, the the machines that we had back then, the computers, were so primitive, but I remember it felt like, when you're at the gas station and you see that dial just keep going and going and going until it finally stops. Well, in this case, it didn't seem like it was ever going to stop, but it was going down. All right. So long story longer, there was a fellow who was in Miami who was an investor, and apparently he'd been investing a long time. He was on margin. Well, when the stock market went down, he owed a lot of money that he had to either bring in or sell his stock to keep his account going. Well, because the market really kept going down for a little while longer, so that first day it was down about 21%, don't remember the exact amount, but eventually went down to about 30%. he had to bring in a lot of money just to get the margin back to an acceptable level. Well, what he ended up doing was this. He went into the broker's office about a week after the market crash, and he was told he might need $60,000 or $70,000. So he said, okay, I've got that. And then when he got there, his broker said, well, because the market's gone down by more, you now have to bring in $130,000. Well, this guy was already distraught because he had lost so much money because of this margin. Because remember, leverage goes both ways. On the upside, it's great, but on the downside, it can really kill you. And so what happened is that he said, okay, I will come back this afternoon with the rest of the money. So when he came back, the branch manager and the broker were in an office. He takes out his briefcase, looks at him, takes out a gun, kills the branch manager, shoots the broker, who ended up becoming paralyzed. Then he shot himself and killed himself.
Oh my God.
Yes.
Are you freaking kidding me?
No. So this was in Miami. I think it was a Merrill Lynch office that this happened in.
Wow.
Yeah. So leverage can be bad. And by the way, that other voice on here is my partner in crime on this podcast, Jocelyn Magana.
I'm the regular guy.
I don't know about regular, but anyway.
Well, I'm a little irregular, but I'm the guy that's not a financial planner or advisor on the team here.
Right. So, and he's also the one who's in control of all the recording instruments and all that. But anyway, leverage is a very interesting thing because, on the upside, it can work great. If the market keeps going up all the time and you're using someone else's money, and as long as you're making more than it costs you to borrow the money, then you're in good shape. Okay. The problem is, of course, that when it goes the other way, it can be a real problem. Let me give you, I looked up today on the internet, on Google or something, just to give you a definition of leverage so you really understand it. So I'm going to read here for just a minute. So the definition of financial leverage, which is also known as leverage or trading on equity, refers to the use of debt to acquire additional assets. The use of financial leverage to control a greater amount of assets by borrowing the money will cause the returns on the owner's cash investment to be amplified. So remember, that's amplified both up and down. And that is with financial leverage. So an increase in the value of the assets will result in a larger gain on the owner's cash when the loan interest rate is less than the rate of increase in the asset's value. A decrease in the value of assets will result in a larger loss on the owner's cash, which is kind of the illustration that I just gave to you. So I don't know about what other financial advisors say. I'm not a big fan of leverage for the reason that we just gave you. You never know when that stock market's going to go down. I mean, here we were in January thinking, the market was going to be great, right, Joss?
What happened, man? I just want to know what happened. I keep I keep waking up telling my wife, look, tell me that was a bad dream. I had this horrible dream. There was this pandemic thing and there was no end in sight. It was so bad. And then she let me know I'm not dreaming.
Exactly. So when so in January we were thinking, wow, this market's going to just keep going. How high is it going to get?
Such big plans for 2020.
Well, we all did, I think.
Yeah.
So by the time March came around and the COVID virus was in full swing and the market was down from top to bottom, I think by about 35%, something in that range.
I remember that big drop.
Yeah, and all of a sudden, and if you were on margin at that point, more than likely you were getting margin calls. The bank was calling you to say, hey, bring in more money or you better start selling. So actually, which reminds me of another story. This is again back, I think it was like 1989 or something in that range. We had a client who had some Amgen stock. Amgen is the biggest biotech company, I think, in the world. It's located in Thousand Oaks, California. And at the time, it was a fairly young company. And this person had a huge amount of Amgen. I was told that outside of institutional investors, it was the largest amount that any single individual owned in the country. I don't know if that's true or not, but that's what I was told. At any rate, we got an inkling that Amgen's earnings were maybe not going to be as good. I mean, we didn't have any inside information, but we just thought, what happens if? So we told the guy, look, you've made a lot of money on this, and he was on margin, okay? And you've made a lot of money on this. Let's take some off the table. He said, oh, no. Amgen's going way higher. And no matter what we did, we couldn't convince him. So eventually the worst case came to happen, and it started going down. And they were, this was, I think it was a Friday. And I believe that over the weekend, or on Monday, they were going to come out with their earnings report. And we said, look, if this is bad, you've got to come up with some money. And he says, I'm not selling. He said, let's just, keep it going. Well, that morning, and if it was Monday, I don't remember, but if it was that Monday morning, they came out with earnings that were not nearly as good as people thought. And of course, the stock started going down. So now we're getting calls from, at the time I was working with, I believe it was Shearson Lehman Brothers. At any rate, I was getting calls from the people at Shearson basically saying, this guy's got to come up with money or we got to sell stock. So of course we call him and he says, you're not selling any of this stock. He says, this thing is going back up. I said, well, then you got to bring in money. He said, I don't have to do that. I said, yeah, you do. So we had this big argument. And I said, look, I am being told by my superiors, by the bank, that if you don't bring the money in, they are going to sell your stock. And of course, he argued with me that you couldn't do that, blah, blah, blah. I said, unfortunately, they can. Well, of course, what happened is that they eventually did sell some of his stock. And he kept saying, can you just hold off? Can you just hold off? Because I know it's going to go back up again. And I say, it might, but what if it doesn't? And that's why they're going to sell. So they ended up selling. And wouldn't you know it, a couple days later, of course, the stock starts going back again. And now he's really upset. He says, I told you guys it was going to go back, but that wasn't the point. The point was he got himself too much in debt. And the bank isn't going to take a chance. Not much different than the housing market in 2008, 2009. When those values started going down and the bank says, I don't have enough equity in this house, not me, but whoever it was, they're coming after you. Well, that's exactly what happened. The offshoot of this was that he tried suing us because he said we didn't have the right to do that. And, or at least he thought about suing us. And his attorney called to try to find out what happened. And his attorney told him, no, they did everything right. But the point was that he was on margin.
So how did he, when somebody gets on margin like that, is that explained to them that look, this is margin at some point, you're going to get a margin call and what that is and how that works? I mean, because he sounds like he had no clue, or maybe he wasn't listening, or what? How does that go down?
Well, I don't know about him personally, whether he knew in advance or not. He should have known because we told him.
Okay.
And also because the firms, when you're on margin, usually they'll send you out something in writing that explains what margin is.
Okay.
Okay, and that you can get margin calls and what the risk is and all that. And my guess is, and although I suppose we should talk to our compliance officer, but my guess is that if we did it with Schwab, I'm 90% certain Schwab will send something out that says you're on, you have a margin loan. Here's what can happen. Here's the good things. Here's the bad things.
Yeah, I imagine, because I think a lot of people could get themselves really hurt playing on margin.
Right. And the reason I use Schwab is because they're our custodian.
Right.
So, but any firm would do the same thing. So, that's kind of what goes on with margin, and it's one of the reasons I don't like it. Now, I was also reading something about a lot of people seem to like these ETFs that will double or triple what you can make or lose, by leveraging.
Were they like leveraged ETFs?
Yes, the leveraged ETFs.
How do those work?
Well, exactly, and it's a little bit different than margin. What happens is, let's say that the market goes up by 10% in a day, and let's just make up numbers here. It goes up by 10%.
All right.
If you have an ETF that's levered to the market, say it's the S&P that went up 10%, it's levered to the S&P, and it's 2 times leverage, it will go up theoretically 20%. Okay, so it's made twice as much as what you just made if you didn't have it leveraged. Some of these have 3 times leverage, okay, which means you could make 30% in a day. All right, so some people think, wow, that's terrific. I can make 2 or 3 times as much as someone else who is in the same investment. The problem is, of course, first of all, it's a two-way street. If the market goes down by 10%, if you have it levered 2 or 3 times, you would be down 20 or 30% in that day or that week or whatever it might be. But let's talk about a day, because these things were really made for day traders. And I say that because some people think that the longer they hold that, the better it is. It's quite the opposite. It's exactly the opposite. Because unless the market moves up every single day, the math on this doesn't work in your favor. Eventually, your investment will keep going down and down and down. And let me give you an example of that. I wrote this out so that I wouldn't mess it up. But let's say you started with $100, and the S&P index was up by 10%.
Okay.
I'm sorry, was down by 10%.
Okay.
Okay. At the end of the day, you'd have $90. You lost 10%.
All right.
If you had a 2 times levered ETF, you'd be down by 20%, or you'd have $80. So in the one case you have 90, the next case you have 80. Let's say the next day, and you held on to the ETF. Let's say the next day, the market goes up by 10%. So your $90 that you have unlevered would go to 99. If you had it levered 2 times, your $80 goes to 96, because it only goes up by 20%. So you're behind, even though it did exactly the same thing, 10% down, 10% up in both, and then 20% down, 20% up. Okay, let's say held it for another day. And let's say the market this time was up again by 10%.
Okay.
All right. So you remember you had $99.
Right.
All right. So that 99 is now worth 108, because that's 10% more.
Okay.
Your $96, remember on the 2 times leverage,
Right.
is now worth 115.2. So you actually are making more in that instance. But now let's take just one more day, and now it goes down by 10%. Well, the person who's not levered, that $108.90 loses 10%, and you go down to $98.10. The guy who is levered, who had $115.20 but loses 20%, that goes down to $92.06. So you're actually almost 5.5% or $5.50 less on being levered to the market. So I know that when your wife, Catherine Magana, my partner, my business partner, when we were at, it was Smith Barney, then became Morgan Stanley, was now Morgan Stanley, they basically were saying to us, you guys can't use this. They would not allow us to use it. And we were saying, why not? Why not? Why not? Well, this is the reason. Because unless you did it only for a day, the compounding that normally helps you over time, because that's how you make a lot of money in the stock market, by compounding, actually works against you in this case. And of course, they weren't interested in being sued for that particular reason.
So who are there instances where people outside of the day trading community are getting involved with these types of products?
Absolutely. And especially people.
Who's selling them to them?
Well, people, people are doing it themselves.
Oh my God.
They're getting out there, and they're saying, hey, this is a great deal, and I can make 2 or 3 times my money.
Okay.
With the same investment, and they don't realize that really, this is a day trading thing. That's it. If you're doing it for longer than a day, you're playing a very risky business. So it's a guess. To me, this is pure gambling. You know how we always hear, the stock market is just like Vegas.
Yeah, I hear that from time to time.
But it's not anything like Vegas. In Vegas, the house has the advantage all the time on every single bet you make. And I believe somebody told me that the best bet in the house is in the dice, in craps.
Oh, is that right?
Right, where after the initial roll comes out, you can put money behind your bet, and I'm not going to get into all of it, but it's almost even, but it's not even.
No, it's never even. It's never, and it never will be even in Vegas.
Exactly.
Or any casino.
Exactly. But with stocks, over the course of a long period of time, the stock market is, at least in the past, has always made money. Now, who knows what's going to happen in the future, but I like those odds. 100% of the time, it's gone up over a longer period of time. So that's kind of my story about leverage. So what do you think, Joss?
Yeah, I'm not real interested in leverage. That first story was pretty bad. Yeah.
But believe me, it happens more often than you know that people get levered and then they get over levered. And the worst thing, the worst thing about normal leverage, or normal margin, is that you're selling stuff at prices that you should be buying them at. Remember, the objective here is to buy low and sell high, not the opposite. All right. So when the market was down here recently, here back in March and April, if people are on margin, they're selling some of those stocks at cheap prices.
Yeah, and the market right now is so volatile. It seems like, you're going to get you're not going to dodge too many margin calls in the market that we're in right now.
No, well, fortunately, the market's come back. But if you were one of those people that had to get out at the bottom, you just missed, in some cases, 70, 80, 100% gains over the last couple of months.
Well, we can never predict the future. Like you said, there was a point when everybody was asking, why is the market going up after it went down 30%? So just seeing the last couple of years and seeing that happen, who knows what this next 6 months to a year is going to look like. I just can't see operating on margin in any way.
No, I wouldn't either. We've been fortunate that some of the, it's an interesting thing. No matter what happens in the marketplace, there's always a bull market somewhere. I know Jim Cramer on CNBC says that all the time, and he's right. There's always a bull market somewhere. You just got to find it. In this particular case, it was technology. So if you had some of these tech stocks, the Zooms of the world, the Apples, the Nvidias, whatever, if you had some of those stocks over the last 2 or 3 months, you would have made a ton of money.
So what do you think about that, though? So do you think that maybe the technology sector might be overweight or bubbled out a little bit, or bubbling, or it seems like it's been doing really well.
Yeah. Well, look, nothing goes straight up without coming back a little bit. Okay. Yeah. When stocks go parabolic, where the chart starts way at the bottom and then just goes straight up, it's never happens that it just stays there. Okay. There's always a correction somewhere, but that doesn't mean that those stocks still aren't either worth holding, or when that correction happens, they're worth buying. Now, I've taken a little bit off the table on some of the tech stocks in my portfolios, but not a lot, but enough to say, hey, let's take some profits here. If it comes back down again, probably buy more. Because what's happened here, I think there's some things that have permanently changed. For instance, I think that people electronically sign documents these days where they didn't before. And this industry didn't want them to do that before. It's changing. Why? Because we're all working from home.
Yeah, nobody can do wet signatures on documents right now, especially people that might be at risk to travel and go into an office. It doesn't make any sense. Right.
Now, DocuSign was a big beneficiary of that over the last year and a half, but this just accelerated everything. And please, again, I say this all the time on every podcast, I'm not recommending that you go out and buy these stocks. I don't know your situation. You may have an advisor, talk to your advisor, do your own research. But DocuSign was one that I purchased here a couple of years ago, and it's up somewhere in the area of 300%. But it looks to me like a lot of the things that were already happening have been accelerated. So those people who let's go back to the margin part, those people who got knocked out, they just missed out. Whereas if you weren't leveraged at all, and you had some cash somewhere along the line, you could have put money to work and really done well over the last couple of 2-3 months in certain stocks. Other stocks, not so well.
True.
Wouldn't want to be in the cruise lines in the last few months. Now, who knows what's going to happen in the future, or the airlines and that type of stuff. But, if the market comes back, if there really is a vaccine, which who knows if there is, we'll get back to a little bit more normal, and then those kind of stocks probably will go up. But again, not a recommendation. Let's see what happens.
Yeah, absolutely.
So that's kind of my story with leverage, and appreciate you guys listening. Jocelyn, it's been great talking with you, and thanks for being my partner. And we'll see you guys in the next Steve Stock Stories.
Always a good time. We'll see you guys later.
All right. Bye-bye.